Welcome newbies. For the uninitiated, this is how things normally go on this channel. We cold open with a fancy, funny, relevant, or lame intro. We then talk about what the market did, and then talk about what the market is going to do. And then the market does the things that I say it's going to do. And in the process, I get some views, you make some money, everyone's a winner. So hit the like button, please and thank you, and here's some cute puppies. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and stocks slipped on Monday as the 10-year Treasury yield rose and investors braced for a packed week of top-tier earnings that could drive or drag the record-setting rally. There was a lot of red, but there were some green spots as well. We saw Nvidia up 3%, leading the mega caps higher. Apple up 0.35%, Google was up 0.44%, and Boeing was up 3% on the day. That was really it, apart from a couple of other names. It was really just a day where major stocks gapped down, found bottoms, and then rallied into the end of the day, however still finishing red on the day. However, Boeing the standout, and Boeing stock was up as much as 4.5% on Mondays as the aircraft manufacturer reached a tentative labor deal with workers who have been on strike for more than a month. The contract would raise pay by 35% over 4 years, increase 401k contributions, but it would not reinstate pension plans, a major union demand. Analysts estimate the contract deal could lead to an additional $1 billion in wage-related expenses for the company over the next 4 years. We also saw Apple was up 0.5 percentage point and Nvidia was up 3.23%, and there was some major news around this, mostly on the back of Qualcomm. They revealed their new AI smartphone chip, which is directed to process AI data. As the market and the world is leaning into AI on phones, the two beneficiaries of that are obviously going to be Nvidia because of the GPU data center and leading market share in the AI race, as well as Apple because they just have such a huge install base of iPhone users. And so on the back of such simple news, Qualcomm revealing their AI smartphone chip, we saw outperformance in the overall tech sector today, mostly led by Apple and Nvidia, but we did see XLK up 0.35% for the day, the only positive sector in a slew of red. The S&P 500 was down 0.27%. The only sector that beat the S&P 500 was XLE, the energy sector. Other than that, it was a brutal day with major selling here in the real estate space on the back of what we saw in yields, but we also saw selling in healthcare, financials, materials, staples, discretionary, communication services. No sector was safe today, and stocks pulled away from the shorter term averages, but longer term averages still look very robust. Look at the 150 and 200 day. However, the 5-day moving average, which can be a little bit noisy, is actually below the 50% mark, and this is not looking good, especially for the 5-day moving average. However, again, the 20-day, 50-day, 100-day still looking very, very solid, and until we actually see this type of action in the 20-day, that's when we can start to get worried. And as it is right now, market breadth and market momentum looks very healthy. Now, this market breadth indicator looks at the S&P 1500 on an equal weight basis, and the majority of the declines we actually saw was in the S&P 600 or small caps, particularly in value core, but actually just across the entire spectrum. We saw significant selling in small caps, mid caps in the value and core space as well, and the only green factor was large cap growth. Every other factor was red on the day, and really this large cap growth story was just like a Google, Apple, Nvidia story. That was really it. Even the large cap growth side did get hit today on the back of higher yields. The 2-year yield, 10-year and 30-year yield were all up nearly 2% in some instances and above 2% in the 10-year and 30-year yield. As a result, the dollar did gain because when yields are paying more cash, you're just going to flock to the dollar. You're going to sell out of stuff like commodities as well as equities. And that's really what we saw. People moving to cash, trying to collect some yield and selling out of their commodities, selling out of gold and selling out of equities. However, silver did buck the trend. It was up 0.38% today, as well as crude. And really, gold showed outperformance relative to equities as a whole. Excluding the Nasdaq 100, we did see outperformance across across all the other indices though. The S&P 500 down 0.18%, the Nasdaq 100 up 0.18%. We actually look at the RSP down 0.85%, telling us that what really held this market up today was the mega caps. Okay, we did see quite a terrible day in the equal weight as well as the IWM small caps. And if you actually just remove the Nasdaq 100, the mega caps, we actually have a pretty brutal day in equities. Very brutal, led by simply higher yields, a higher dollar. That's going to tangibly affect overall market pricing and market sentiment, especially going into this huge week of earnings. Diving into the S&P 500, we haven't seen much changes in the gamma flip. We tend to be in this equilibrium zone in positive gamma where we buy dips and sell rips. However, we did see quite volatile price action. Look at this wick, and if we actually just dive into the 1-day chart, look at the 1-minute chart, you can see that we sort of tentatively opened, drifted a little higher, put in a top for the day, had a vicious move to the downside, then put in a bottom, and then just sort of continued all the way up. We did break the highs after we put in the low right here. However, we didn't break the day's highs, and we were down 0.18% for the day in the S&P 500. So very volatile day. If you were on the right side of the trade, both bulls and bears really did make quite a bit of money today. However, we are still in positive gamma, and that means any dips we do get, like today, you do want to buy those dips and aim for the 59.05 area. In positive gamma, we buy dips, sell rips, but ideally you want to buy at the gamma flip zone, see some strength. If we don't go below it, that would be the ideal location to buy and aim for the 95.05 area. But sometimes you just don't get that, and these type of red days is all you're going to get in a bull market. Looking at the Nasdaq 100, very similar situation in positive gamma, sort of in between the gamma flip and core resistance zones, and a stone's throw away from all-time highs, although the market or mega cap struggling to get these all-time highs. But we'll see what earnings season brings. This has been a good earnings season so far. And then looking at the RTY, down 0.58%, it bounced right on the gamma flip at 2240. We're going to see if this moves tomorrow. However, as long as this level right here holds in the IWM, we did go put in this high relative to these highs we made right here. If this 2190 level holds and we sort of find a bottom here and continue to move higher, that would be trend continuation. Yes, this is an ugly candle. The IWM is a lot more volatile than any other normal index. However, this still looks largely constructive, and the only time we would really get worried for the IWM is when we break this area. If we break the 2190 area, that's when we can start to look at downside targets closer to the 2000 level. However, let's not count our eggs before they hatch. And the RSP down 0.85% today. Not that great. The S&P 500 outperformed, the Nasdaq 100 outperformed, but still looking largely constructive. And like the IWM, unless we actually go ahead and break like the 175 area, 176 area, that's when I would really start to get worried. But we could pull a significant amount more, about 3 or 4% more, put in a bottom and then continue the rally, and we would still see higher highs, higher lows in the RSP. The RSP is poised to go higher, and I do think any type of volatility we do get in the market right now, guys, you do want to buy this dip, because after this week, we're actually headed into seasonally what is the best 6-week period of the year, sort of this end of October into the first week of January. That tends to be a very good week, and we're going to start talking about some of the seasonal factors that we do get in November and in December. So all in all, any dips we do get in this market, you want to buy those dips, and you want to start positioning yourself for an end of year run to the 6,000, 6,100 area. I think that's where we're going to end the year, or at least that's where we're going to finish in the first week, second week of January. We're going to be at around the 6,000 to 6,100 area, and you do want to be positioned ahead of time of that. And you do want to be positioned ahead of time because you don't want to go out and chase that rally. So buy dips, guys. If you're looking at indices, I like the RSP, I like the CAF index, and I do like the ticker MOAT. Yes, they were down pretty big today, but opportunity, remember that. Individual names, I do like Google, I like PayPal, I like Paycom Software. For those of you that are in Australia, I like PXA, PEXA Group Limited, very good stock. stock, great business, a monopoly. I like this name. I'm going to start buying this name. So that's where I would really put money to work in indices and individual stocks. And I will tell you exactly when is the time to get into bonds, because I think bonds, TLT specifically, looking really, really attractive at these levels right here, the 92 level. We're approaching some very, very key and critical levels of support, particularly in the 90 to 91 area. I think it's going to be a great place to load up for bonds looking into 2025, where I do think yields are going to materially move lower. I think the reason why yields are moving higher right now is just on the back of the stronger economic data we got and the market pricing in less Fed cuts than anticipated. However, I do see the Fed funds at the 3.5 or 3% mark in the next 12 to 18 months. So guys, I just told you everything you need to know. Buy dips, sell rips. We are going higher into the end of the year. And looking at sentiment, this is BOFA's bull bear indicator. It ticked down from the 7.1 level to the 6.8, meaning that we did see a decrease in overall sentiment last week, but we still remain in very bullish sentiment, although not extreme bullish or overly bullish. This is exactly where you want to see sentiment in a bull market. Looking at seasonality though, this is the seasonal composition of the Nasdaq 100 in the last quarter of the year from October into December. And generally what we see, guys, is flat to sluggish returns all the way up until November 18th. That's when we actually normally put in a bottom, not the absolute bottom, but we do put in a bottom before we absolutely rally into the end of the year. We see a 6% return peak to trough, and this is when tech stocks normally outperform. And guys, this is 6 weeks where tech goes on a rally, higher highs, higher lows. We do put in a little bit of a dip very close to the Christmas period, and then we just continue to move higher into the new year. We see very much the same with small caps. We see very lackluster returns here in October, and then November into December, we see blockbuster returns. Stocks are kind of bucking this trend right now. We're seeing very robust small cap returns. August is actually up about 2% so far, but anything can happen from now until the end of the month. And the reason why stocks are doing so well has to do with the earnings picture, not necessarily what's happening right now, but what's going to happen in the future. Because at the end of the day, you do have to understand the quarter we're in right now is probably going to be the worst fundamental quarter for the next 12 to 15 months. After we report 5% growth this quarter, we are going to see double-digit growth every single quarter for the next 4 quarters. That's actually going into the fourth quarter, 2025. Very, very strong growth. On the back of this, margins are also improving and set to expand into the new year. Margins currently sitting at 12.5%. We're looking at a 14% margin over the next couple of quarters. Very, very strong. This is the type of stuff you see in bull markets. When earnings are growing and margins are expanding, stocks do very, very well. And what management teams do with that money is they just return it back to shareholders via share buybacks. And BOFA's corporate client buybacks is well above the S&P 500 average trend. And with BOFA's corporate clients significantly increasing stock buybacks, they are essentially defying recession fears, indicating a positive market outlook, suggesting that these companies expect ongoing and stability in the future. But there are some risks to this market. The big one being the election. All else equal, BOFA estimates that a Harris proposal to raise the corporate tax rate from 21% to 28% would see a 5% hit to EPS in aggregate, whereas a Trump proposal would actually see a lower corporate tax rate from 21 to 15%. That would boost EPS by about 4% in 2025. So who you elect is going to drastically affect the overall earnings picture into 2025. So pick your poison wisely. And diving into the macro, guys, this is BOFA's GDP tracking estimate, tracking very similarly to the Fed's GDP now at 3% growth. Economic expansion and economic growth looking really, really robust. And also looking into US federal corporate income tax receipts flowing into the Treasury. It hit a new all-time high at $540 billion in 2024, telling us that profits in businesses must be really, really good, especially since the current tax collections are based on a 21% standard rate, whereas before 2018, they were based on a 35% standard rate. Kind of crazy to see this. Profits are very, very good in the current market. But that's enough with the macro. Looking at the overall data this week, we have a very light week of data, but there is still stuff we need to pay attention to. Mortgage applications is one of them. Existing home sales and then new home sales. So a lot of housing market data is going to come to fruition, especially with lower rates, Fed rate cuts. We want to see if this is going to spur on growth into that side of the economy, because that's really going to drive growth into 2025. We also get manufacturing data, PMIs on the 24th, and then initial jobless claims on the 24th as well. That's Thursday. Then Friday, we get durable goods, a very, very critical data print, a high frequency, high quality data point. And then we also get University of Michigan sentiment. And guys, so mortgage applications in a couple of days, we actually don't have a consensus estimate. Very interesting. But home sales on the same day, we're aiming for 3.89 to 3.9 million. That's the consensus and BOFA's estimates. And then earnings for the rest of the week. Looking at Tuesday, guys, we have a big day of earnings. Verizon, GM, 3M, RTX, GE Aerospace, Lockheed, they're all reporting earnings before the open. After the open, we get Seagate and Enphase, Texas Instruments as well. And that's really it for Tuesday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.